Welcome back. If you've just joined us, you're watching Stockwatch, and joining me this evening in studio are Rowan Williams from Nitrogen Fund Managers and Gerbrand Smit from NEFG Fund Managers. And if you were watching last night, please bear with my repetition. But as you may know, MoneyWeb and the Financial Mail run very successful stock pick competitions. And though ours is going to be more informal, we are collecting some 2017 stock picks from our regular guests and also you, our viewers. We'll keep tabs on the picks and the performances throughout the year. So if you like, please text and email us your picks this week. One pick per person, and of course your question. So it's stock and the question to 33814, or you can use email, which is stockwatch@bdtv.co.za. Gerbrand, Rowan, nice to have you both in studio tonight.
Sure.
I must mention some of the picks so far, things like Baldwin, Basil Reed, Aspen, Telkom, York Timbers, Rolfs, Master Drilling. So there sort of seems to be a concentration among the small caps, and I'll get yours towards the end of the program. But Rowan, if I may start with you,
yes.
Today finally seemed to be the day that some UK-sensitive shares had their moment in the sun. Do you think it's a one-off, or do you think actually you might see some sort of genuine recovery in shares like Capital and Counties and Intu and Brait and Old Mutual?
Yeah, I think a lot of it was currency-driven, obviously, following May's announcement that they would put the final sort of terms of the Brexit to a vote. That was a sort of a bit of a sigh of relief, and we saw the pound recover, and that was really, I think, driving some of the stocks up, particularly on the JSE, but some of those more interest rate sensitive stocks were also up in the UK. So the property stocks, the REITs in particular. Yeah, look, I think there's a long road ahead with Brexit, so it's going to be sort of up and down and a bit muddled. But look, the pound has sold off a lot and is very weak, so it could consolidate a bit from these levels, but I'm not that optimistic.
Gerbrand, how about you?
Yeah, look, you want to get optimistic normally in circumstances like these. I just think, you know, if they don't get slammed quite hard by the European Union, you're going to see some of the other guys wanting to exit as well. So it's actually a mechanism of protecting the euro. You're going to have to hit UK pretty hard. So I'm still scared of what's going to happen there, because otherwise you're going to see France, Italy, Netherlands, all of them having referendums and wanting to leave the European Union at this stage. So I don't think it's going to be that nice and easy road for them ahead. I think it's going to be difficult, because otherwise you're going to see bigger consequences longer term for the whole European Union. And that's why I won't be positive yet. I mean, some of the valuations are okay. We're happy about some of the valuations. We just think they're not going to get off lightly on the consequences of their actions.
Well, I suppose, but the way she put it was so... It's so beguiling. It's as if, you know, you can't not be friends with us, is the impression that I got. So it would be really churlish of the Europeans to hit them back hard. But as you say, it's, you know, it's a big gamble, and we'll see if it plays out. There's also the company news is certainly ratcheting up, lots of sales updates, and a couple more from retailers. So we've had this really interesting, I suppose, surge in the retail stocks, despite not all of them being particularly good. Woolworths, for example, last week, and yet the share started rallying and prompted a retail rally. Then you had Mr. Price out today, Shoprite, Holdsport, and also Cashbuild, which is sort of retail sensitive. Rowan, did you think that the fall or the correction maybe that we saw in shares like Mr. Price and in Shoprite actually towards the close of trade was justified, especially given the events of the last couple of trading days?
So, I mean, the interesting thing is stock prices are based on expectations. So it's the most recent expectations that have been boiled in, and I guess now the recent trading updates against those expectations, and that's why you've seen quite a lot of dispersion in terms of performance of the various counters. So, for example, Truworths, obviously, expectations were very low. They had given previous guidance. So what we're seeing is, to some extent, a bottoming out of recent trends and maybe an uptick from these levels. So we saw quite a big bounce there, particularly in Truworths, Woolies to some extent as well. Whereas Mr. Price, really, we're not seeing a discontinuation of the trend. It's still trending down, and hence reinforcing the weakness that they've been experiencing. There's been quite a big distinction between the food retailers and obviously the clothing retailers in terms of their performance as well.
Gerard, and what did you make of Shoprite initially rallying and then closing lower? Because it did seem to be a very strong performance, and the non-South African supermarkets have just knocked it out of the park.
Constant currency, something like 51%.
Yeah, and I mean, and especially if you consider what Massmart put out yesterday, saying that things were still very weak for all the operations outside of South Africa.
I think we like Shoprite at the moment. We think the trading statement from them is certainly that they're the winners in that specific sector at the moment. They're certainly beating Pick n Pay on revenue growth. They're certainly beating Massmart on revenue growth. So from that perspective and pricing perspective, we certainly think there was a few opportunities during the last year you could have purchased some Shoprites. The only thing that I think is still hanging over it is this whole Retail Africa Steinhoff deal that people are concerned about. Today's update was good. It's brilliant in these circumstances. Turnover growth of about 15%, if I got it correct. Offshore turnover growth 31, constant currency 51 or something. Amazing that these guys are delivering that. Concern probably why Son is leaving at the moment, and then the Steinhoff deal hanging over it at the moment.
Rowan, what do you make of the Steinhoff deal? A lot of analysts are very skeptical about it. They say they can't see the strategic rationale. And they just, well, I suppose everyone's up in the air because you don't know what the valuations are.
Yeah, so I mean, we've seen comments from the media saying, what is the stock swap ratio? Because that really gets to the fundamentals of what the relative value of Retail Africa versus Shoprite is. But I think, it comes down to Christo Wiese's sort of retail ambitions for his major holdings and wanting to consolidate those and I guess dress them up in what, from his perspective, is a coherent retail champion for Africa.
So would you buy it?
Look, as I said, it gets down to the fundamentals. It looks like on sort of what we're seeing is it's a bit too beneficial at this point in time for Steinhoff, obviously at the expense of Shoprite shareholders. So in terms of the current form, and it would come down to that ratio, I'm not that excited about it sort of in its current form.
Okay. Moving on to questions and more stock picks coming through. Lester says his stock pick for 2017 is ArcelorMittal South Africa. Maybe we can discuss that. But he said, can I please have the panel's view on the above stock? The long-term technical setup is attractive, but what's the outlook fundamentally? Gerbrand, I don't know if you look at ArcelorMittal.
Yeah, we do. We stay close by. So yeah, it's an interesting one. We saw what happened to steel prices, and we also saw what happened to iron ore prices. So the input prices went up, but the output prices went up as well. So if you just look at what's happening to steel prices and the tariffs that came through, etc., it should be good for ArcelorMittal. But at the moment, there's just no volumes at the moment. So from a local front, no volumes. Export side, I think the guys can still get it cheaper from China. So from a volume perspective, a problem, but from a pricing perspective, certainly you probably will see upside in it. But there's lots of risk in this business. Okay, so it's not for the widows and orphans. It's probably not for everyone. I see some of the value fund managers in South Africa are stocked up on the share. John Bickard, for instance, from Investec Value is holding 6 or 7% of his fund in that at the moment. You got it right last year with gold. Maybe we'll get it again with metal. We still don't like a picture where we don't think the fundamental business should be around in 10 or 20 years from now. They're not competitive in the global scale. They used to be because they had a nice deal with Kumba, etc. in the long term. They stuffed that up. So we still don't like it. But it might double in this year. But we're not going to put good money behind it at the moment.
Rowan, how about you?
Yeah, I mean, I think I largely echo that sentiment. It's, kind of optionality. I mean, it very much depends on short-term price movements, some tariff protection, input costs, and end-user demand. So, I mean, it could, there could be sort of favorable developments on those fronts, but longer term, the sort of local manufacturing ability and capability, it's not something I think you want to sort of bet on long term. So yeah, it could be speculative buy now, but we don't see it as a long-term opportunity.
Okay. Adapt IT and Ansys, are these shares that you look at? As well as Naspers?
Yeah, Adapt IT I know fairly well. In my old private equity days, I was actually invested in it when it was known as Infowave, so I've had a long association with the business. Very much like the management team, very solid, Durban-based, and they're really consolidating the business application software market and have done very smart acquisitions, and the structure has been good, partnering, I think, with very good entrepreneurs and really building and corporatizing those businesses. So we're seeing a lot of acquisition-led growth, but I think it's sustainable because they're bedding down those businesses.
I mean, and you have seen that reflected in the share price. So
Certainly.
just under 16 Rand, and it's had a phenomenal run. But could it be the year that Adapt IT doesn't shoot the lights out and maybe just consolidates? Because it wouldn't be unreasonable to expect maybe for it to not do very much after having done so much. I don't know if that's just...
No, I think that's a fair point. A lot of the growth, the EPS growth, has been driven by acquisition. So they need to continue to make earnings-enhancing acquisitions to continue to drive the earnings growth. In the absence of that, we could see growth tailing off, and hence, share price appreciation tailing off.
Gerbrand, do you have a view on
Yeah,
Adapt
look,
IT?
it's almost, Adapt IT is almost like a small EOH, and they got probably more leg room to grow than EOH because they can make smaller acquisitions that's still meaningful. EOH is probably a bit bigger. We're still holders of EOH because the growth hasn't broken yet. And if you pay 20p and the thing grows by 20, it's certainly something you want to hold in your portfolio.
I mean, there was a bit of a wobble, though, for EOH.
Yeah, but
initially
the growth has
year.
never stopped. I mean, from if you do H1, H2 on that specific company, they've never had negative earnings growth. They've always had 20% on top of that for the last 6 or 7 years. So it's something you probably shouldn't have sold, and it hasn't been time to sell. The same with Adapt IT. It's trading at a bit of a higher multiple than EOH because there's probably more leg room for them to do smaller acquisitions and have some upside. But until the growth stops, you certainly want to probably be a holder of both of those.
Okay. And what about Ansys and Naspers? Two very different companies.
Ansys is just too small. I saw it shot the lights out. The liquidity is not there. So from a fund management point of view, we can't hold those. Maybe from a retail perspective, individual client, they might go there. But from a Naspers point of view, we all know the sum of the part valuation. We all know it should be 3,600. My concern there is 10 cents overvalued. They're still delivering. So if you think Adapt IT is still delivering, 10 cents still delivering. The concern there is 45 PE on 10 cents. It's probably justified in Naspers discount, but it's all going to depend on what 10 cents is going to do going forward.
Rowan, I mean, do you
like it, we have some, but we're underweight.
Okay. Would you be underweight or overweight Naspers?
Well, I mean, it's such a big part of an index. So, to be just equal weight, it's already a big bet in your portfolio. I think what you can do, we as a hedge fund, we're a bit more dynamic. We can buy and sell and trade a little bit. We have a detailed model on the NAV, and when it does look cheap, a wider discount relative to 10 cent. You can buy it narrow. Sometimes maybe we'll top and tail it and trade it that way and look to add some value. Look, fundamentally, I like Tencent as a business. I mean, the Chinese internet economy, mobile users, gaming, it's all in the right places, and there's, I think a lot of room for continued growth. So it's almost a must-hold stock. I guess you can either own it directly or via Naspers. You're getting it in a discount through Naspers. So it makes a lot of sense. I guess classifieds, the other parts of the business, have some potential. We'd like to see a little bit more delivery. But I think it's attractive.
And maybe just a comment on all the ex-Tencent businesses. Are you not worried they're going to be a drag on Naspers? Because none of them are producing the goods, it seems, at the moment. And even the sort of e-commerce businesses, they're costing a lot of money.
Yeah, no, so I think, and that's why there's such a significant discount to that sort of NAV of 3,600 Rand a share, because they are, at the moment, unfortunately, are destroying value. The market's not convinced that they will ever create value. The best opportunity looks like it's in the classifieds, OLX, and the related assets. Those based on Schibsted can be very profitable with very high margins. But we'd like to see more delivery. Until you do see delivery, it will continue to trade at a discount.
Okay. We'll leave it there for the moment. If you'd like to send questions, also picks, please do. You can SMS us stock and question or pick to 33814 or email stockwatch@bdtv.co.za.